What's the January effect for US stocks, and is it real? So for years, people believed that US stocks were more likely to rise in January than in any other month in the year. This idea, known as the January effect, was once very difficult to argue with. Research showed that January gains were several times larger than the average monthly gains, especially for small stocks between 1940 and the mid-1970s. But over time, this effect has seemed to fade. By around 2000, it wasn't as consistent, and more recently, it hasn't been as reliable. So what's different about this January? This year, US stocks haven't started off as strong. The market's been struggling, continuing a sell-off that began in the final days of 2024, and over $1 trillion in value has been wiped out so far. There are other January-related market theories, like the January barometer. This bit of Wall Street wisdom suggests that how the market performs in January sets the tone for the entire year. If stocks go up in January, it's seen as a good signal for the year ahead, and if they drop, it could signal trouble. So why might the January effect have faded? Well, there are a couple ideas. One is that markets have already priced in the January effect, making it less noticeable. Another theory is that the market itself has changed, with more focus directed toward large tech stocks. This shift could be muting the impact of what used to drive the January effect.